Class 12 Accountancy presented by eduxit.com. In this video, we are going to provide accounting for partnership, basic concepts, nature of partnership. We are already familiar with the concept of sole proprietorship, right? There we have only one person who is also called as sole proprietor who is managing the business. This model works for businesses which are small in size and the required amount of capital is also small. However, if someone wants to start a business that is much bigger, we need more capital, and to manage such a big business, more number of persons are required. So, when people face this problem, they adopt the partnership form of organization. Leaving other things apart and considering only accounting, the accounting for this partnership form of organization has its own distinctive characteristics. In simple terms, the partnership form of organization comes into picture when two or more persons come together to establish a business with the motive of sharing its profits. Usually, when two persons are doing business, it is common that there will be some sort of disagreement or dispute among the partners. This could be majorly when it is time to distribute the profits among the partners. One partner might say that it needs to be a bigger share, and the other might be concerned about the less share allocated to him. To resolve this situation or to settle their dispute, we have Indian Partnership Act 1932 and apply it. These differences among the partners might not be just limited to the sharing of the profits. It could be related to the calculation of interest on capital, interest on drawings, and maintenance of partners' capital accounts, etc. In addition to this, when we are dealing with the partnership, we should already be aware of how to do the adjustments when a partner dies and how to do the adjustments when a new partner joins the firm, etc. All these things are special situations, right? We'll learn about how to deal with these special situations from the perspective of accounting. All these details will be discussed in a series of chapters. But for now, let's discuss about how profits are distributed and how the capital accounts are maintained, etc. in this chapter. Let's first start with the nature of the partnership. Here, the term partnership refers to two or more persons joining hands together for the common purpose of setting up a business. Once the business is set up, they should not just share the profits. If there is any loss in the business, they should share the losses also. Now, where did they get this from? This is defined in the Indian Partnership Act Section 4. It defines the partnership as relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. See, the business is started doesn't mean that every partner should actively participate in the affairs of the business. It could be just one partner who might be actively involved in the affairs of the business. But pay attention to the wording, any of them acting for all. So, when a partner is taking any business decision, it is equal to all the partners have together taken the decision. If any of his actions results in a loss, the loss has to be borne by all the partners. If any of his actions bring huge profits for the business, it will be like all the partners have collectively responsible for the profits, and so the profits should be shared among them. Just now we have discussed that the partnership is formed by two or more persons, right? So each of these persons are called as partners. So this person is called as a partner, this person is also called as a partner, and this person is also called as a partner, and this person is also called as a partner. We call all these partners collectively as firm. Now when a business is started, it will have some name, right? This name is called as firm's name. When you learn about companies, you will learn that the company is a legal entity. But a firm is not like that. Here, the business is not a separate legal entity. Every partner of the business is a legal entity. By legal entity, I mean that every partner who is participating in the partnership is a legal entity. So this person is a legal entity, this person is a legal entity, this person is a legal entity, and this person is also a legal entity. There is no other legal entity. What I mean is that the business cannot be called as a legal entity just like we did in case of a company. These partners can sue others and they can also be sued legally by other legal entities. They can take some legal action on others and others can also take some legal action on them. This is what it means. That said, let's just dive into the essential features of partnership. The first feature of partnership is that there should be two or more persons. In other words, if there is just one person, that one person cannot form a partnership. There should be minimum two persons. There could be more than two also. That doesn't mean that we can have 1000 partners. There is a limit to this. As per the section 464 of the Companies Act 2013, the maximum number of partners that can be part of a partnership firm can be set by the central government. They can say that the maximum number of partners is 10 or 64 or 99, but this number should not be more than 100. In other words, the central government cannot say that the number of partners could be 101. That will not be in accordance with the section 464 of the Companies Act 2013. The number of partners should not be more than 100. Who says that? It is the section 464 of the Companies Act 2013. Now, you might ask me a question. What is this number? You are telling that the central government can set it to 10 or 64 or 99 or any number, but what is the actual number? The answer is 50. This might change in the future, but for now, the maximum number of partners in a firm as specified by the central government is 50. Moving on, the next essential feature of the partnership is agreement. Now, the partnership is the result of what? Result of an agreement. Agreement? Agreement among whom? It is agreement between two or more persons. Okay, what is this agreement for? This agreement is to do business. Okay, and what else? And share its profits. Okay, and what else? And losses. Once the partnership agreement is made, this agreement becomes the basis of relationship between the partners. It is not necessary that they should prepare the agreement and then sign it. They could do that also, but that's not necessary. They could just orally agree. It is also valid. But it is better to have a written agreement. As we have discussed earlier, if there is any dispute or they disagree about something, they can go back and refer to the agreement and avoid such disputes. Otherwise, one partner will say that I am managing a complex task, I should be paid. Another partner might say that I was agreed to be paid a salary. To avoid all these disagreements, we should have an agreement made. They can then bring that agreement and refer to it. Oh yeah, this is what we have agreed. Sorry man, my mistake, forgive me, okay? Forgiven. Let's get into business, okay? The partners got back to the business. Let's get back to our discussion. The third essential feature of the partnership is business. The partnership agreement should be to carry on some business. Now let's take an example. Two people have jointly purchased a building and became the owners. When they purchased a building, they become joint owners of the building. Can we call them as partners? No, we can't call this as partnership. But if they are in the business of buying and selling the buildings for the purpose of making profits, then we call them as partners. That's it about the business. The next essential feature of partnership is mutual agency. See, when there are multiple partners, the affairs of the business can be carried out by all of them. It could also be possible that the affairs of the business can be carried out by only one of them. In such a case, this one partner will be acting on behalf of all the rest of the partners. Now, let us understand more deeply what we mean by one partner will be acting on behalf of all the rest of the partners. This implies two things. First, every partner has a legal right to participate in the affairs of the business and conduct the business. Second, there is something called mutual agency that exists among all the partners. This means that every partner is the principal as well as the agent for all the other partners. Here, the word principal means that the partner is responsible for the financial well being of the business, and agent means that he will be representing all the partners. In other words, he attends a meeting with the suppliers and promises them that their firm will buy goods from them. Here, the promise is not just for him, it is made on behalf of all the rest of the partners. If there are 19 partners in a firm, this partner is promising on behalf of himself as well as 18 other partners in the firm. If he is signing a contract, he is signing on behalf of himself and the rest of the 18 other partners. So, when he is signing the contract, he is binding himself and all the other partners to the contract. Similarly, if any other partner signs a different contract, this partner is also legally bound to that contract. This concept of the relationship of mutual agency is very important. It is so important that if the element of mutual agency is not there, there is no partnership at all. That's it. Okay. Now let's continue our discussion about the essential features of partnership. The next essential feature of partnership is sharing of profit. This is another important element of partnership. When we say that there should be sharing of profit, it doesn't mean that the partners would share only the profits. They should also share any of the losses arising in the business. Why we are stressing on this is that when we consider the definition given in the Partnership Act, it describes the partnership as the relation between people who agree to share the profits of a business. So it is possible that someone in their initial stages of learning partnership might assume that, okay, it is just sharing of profits and I don't have to share losses. This is a good deal. Wait, it's not so. Share the profits of a business also means that sharing of the losses also. That said, it is very important that you understand that there is not just sharing of profits, there is also sharing of losses. One more thing. When two persons join hands to do some charity, there is always some giving in the charity, right? There is no profit and there is no loss. So we cannot call it as partnership. Well, that's it about sharing of profits. Let us now jump to the next and last essential feature of the partnership, that is liability of partners. Now, when conducting the business, it is possible that the business has purchased some goods on credit. It might have purchased some services on credit. The business is liable to pay these liabilities. In case the business is not able to clear these liabilities, the partners have to pay these liabilities even if it requires selling their private assets. So this implies that the liability of the partners is unlimited. They are collectively liable to pay the liabilities of the business. When I say they, I am referring to each and every partner in the business. That's all about the nature of partnership. In the next video, we'll discuss about the partnership deed. Catch you then, and thanks for watching this video. Edixit.com is started to promote effective and efficient learning process to help the students with their learning requirements. To watch all our videos, please subscribe to our channel. Also, please click on the bell icon to receive a notification as soon as a new video is published. Please click on the like button if you like this video. Thanks for watching.